Welcome to Marketing Demystified, the podcast that connects the dots for business leaders to drive revenue through effective marketing strategy. We chat with marketing experts on different topics that will help you ramp up your revenue. We stream live on LinkedIn, Twitter, and YouTube, and you can listen to us on your favorite podcast platforms. Marketing Demystified, the podcast, is presented to you by Growgetter, your partner in growth marketing. And here's today's episode.
Hello, everyone. Are you ready to be inspired and informed and empowered with practical tips to boost your marketing efforts? You are in the right place. Welcome to Marketing Demystified. I'm your host, Jenn Mancusi, CEO and co-founder of Growgetter, your growth marketing partner. What kills M&A deals and capital raises? Sometimes it might be market conditions or bad timing, but oftentimes it's finding out 18 months too late that your business wasn't ready for the process. Today, we're talking about M&A and capital planning and the work that needs to happen sometimes years before you're facing these high stakes moments. This is all about preparing your business to perform well under scrutiny so that when opportunity knocks, you are ready. I'm joined today by Kristin Luck, Growgetter co-founder and managing director at Oberon Securities. Kristin's a serial entrepreneur with multiple PE-backed exits ranging from $30 million to $450 million. She's built and sold companies and now works as a licensed investment banker, helping founders navigate M&A and capital planning. She knows what it takes to prepare for these high-stakes moments because she's lived it from literally every angle. Today, she's going to share what really goes into M&A and capital planning, why this work needs to start years in advance, and the three critical areas every business owner should optimize now. For those of you joining us live today, we're also going to be hosting a webinar on this topic later in the month, so feel free to scan the QR code on your screen and register for that session. But for now, let's do this thing. Welcome to the show, Kristin.
Thanks for having me, Jen.
So excited to have this conversation.
Yeah. I love talking about capital planning, so this is perfect.
Good. Well, it's going to be a good chat today. And I want to kind of start by maybe defining some of what we're going to be talking about today. So just starting with the basics, when we talk about a capital event or a growth moment that requires M&A and capital planning, what exactly qualifies? What are the different scenarios where a business owner should be thinking about this work?
Yeah, a growth event is any moment where outside capital or a transaction is needed to sort of unlock the next phase of the business. And so when I think about growth events, I think about sell-side M&A, whether you're selling your entire company, you're doing a partial sale, or you're doing a recapitalization. It also includes buy-side M&A, so that could be acquiring other firms to help you scale. And it could also include capital raises, so taking on debt, getting equity or venture or growth funding. And then lastly, and I think a lot of folks overlook this particular category, is internal transition. So that could be management buyouts. It could be succession planning. So say you're looking to retire or you want to spend more time outside of the business. Who is a candidate internally, or do you need to hire someone externally in order to run the business in your place? So all of those categories sort of qualify as growth events. But I would also say even non-events qualify. So if you're hiring a CFO, if you're bringing on a major strategic partner or considering an ESOP, that's a growth event that requires planning. And I think the mistake most owners make is they think the event triggers the planning, but it's actually the opposite. The planning should really trigger your readiness for the event. So my rule of thumb is if the outcome of a decision could materially change who owns, controls, or funds your business, then you're in growth event territory.
That's interesting. I like that perspective of like the event doesn't trigger the planning. You've got to be kind of planning all along. And what about like everything that you're describing? There's a lot of options, right?
There's a lot of options.
If I'm thinking like kind of way down the road 2-3 years in the future for my business, is the planning similar? Is the process similar regardless if you're thinking about an internal transition or a capital raise or some sort of M&A event?
Absolutely. I think there are some instances, of course, where something fundamental happens to the business and you need to address it in a very short period of time and you don't have that time to plan for it. I mean, that's kind of a worst case scenario. But I think the number one reason folks run into trouble in growth events is that founders wait just too long to start preparing. So I'll, give a sell side M&A perspective. Like a founder gets an inbound offer and they kind of go into reactive mode instead of coming in pre-positioned, which is super important. From the founder side, I would say, people run into trouble. And I'm just using sell side M&A as an example. They get an emotional overattachment to a valuation that they might receive that might not be accurate. They might have poor financial hygiene internally, meaning that their books really aren't in order. They could have a lot of undocumented processes. They could have key person dependency. So for instance, if your business cannot run without you for any period of time, that's a key person dependency. I think that we see a lot of that regardless of what type of capital event is. Like those are some really key things that you need to address before you go into any type of event.
That's a good segue, because that was sort of my next question for you, is like, what are some of the reasons why M&A deals fall apart, right? You've seen this from both sides, like been through multiple exits and now as a banker, like what are some of the biggest reasons why an M&A deal might fail or a capital raise falls apart, like the common pitfalls that businesses are entering unprepared? Like what's actually at stake here?
Yeah, a lot. I think there's a lot at stake. And I am unfortunately someone who learns things the hard way. And the first company sale that I went through, like we were just woefully unprepared for it. And I had to pull many, 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 many all-nighters just trying to get our financial documents, our operational documents, our processes, our customer information. We weren't using a CRM system. We were 30 million in revenue. I mean, that's just crazy. So for me, I learned things the hard way, but I think one of the things that I really love about the investment banking work that I do now is that I can help other founders not make the same mistakes that I did and to go into processes really prepared so that you can really maximize your valuation. And that's important whether you're selling the company or whether you're going out for a round of funding. Making sure that your valuation is maximized is really important. So, you sort of pose the question, like, why do deals fall apart? Again, I think from the founder side, it's this, emotional overattachment to a valuation. I've seen that, again, financial hygiene is really important. Undocumented processes, not having a CRM, that key person dependency. From the banker side, deals fall apart in diligence when the story the CIM tells, and a CIM is a confidential information memorandum. It's what sort of highlights your entire business and all the work that you've done over the years that you've built it. But when that story doesn't match the data room, that gap destroys trust and valuation simultaneously. And there's a couple common pitfalls that I see when I'm looking at prepping companies to go into market. So that could be customer concentration. And by that, I mean, maybe you've got a $30 million business, but 15 million of that business is coming from Google. That is high customer concentration. So if you lose that one client, 50% of your revenue goes away overnight. And I think a lot of people put a lot of value on having these big, whale clients, which of course is important, but you don't want to have too much dependency on one or two clients. So customer concentration, very important to address. Having revenue that isn't recurring or contracted can, if you just have ad hoc revenue and you have a hard time forecasting what your revenue is going to be from month to month, that's a pitfall. If you have technology and there's unclear IP ownership, that can be problematic. Messy cap table. So say you've got lots and lots of small investors and a very big cap table, that can be problematic. And then earnout structures that founders don't fully understand going in. So if you're not familiar with what an earnout is, typically when you're selling your company, you get a certain amount upfront in cash, and then you get a certain amount based on future revenue targets that you will need to meet in order to sort of unlock that next tranche of cash. And a lot of founders go into those earnouts not really understanding how that earnout works and how they're going to get that money out of the deal. So understanding that is super important. And there's a lot at stake beyond money. Your team, your clients, your legacy from the business, and I think your own psychological readiness for what comes after. Those are all super important things.
Yeah. So all of the things that you're kind of talking about, if you put yourself in the shoes of a first-time founder, early stage, and they're going, I have no idea what a sim is. I have no idea what a data room is. I've never seen a cap table before. Like, it feels like a lot of information to learn. Like, where would you recommend kind of going to educate yourself on some of these things before you get there, right? Because I imagine getting to that event or to that process and starting to learn those things for the first time is going to be really overwhelming.
It's terrible. It's terrible. And I've done it. I've gone in a process like, I have no idea what's going on right now or what any of these terms mean. And, the first company that I sold, there was the internet, but you couldn't just regularly Google information for things, and particularly like this. It's not like in the age of AI where you just type in like, what's a sim? And it'll give you this whole explanation. So I would say, if you're unclear on what those things are and you're looking at a capital event, say in the next 24 to 36 months or even 12 months, I would say, start working with somebody on how to best optimize the business and who can explain all those terms to you and who will help step you through that process leading up to a transaction. Whether that's a capital raise or it's an M&A event, but having an understanding of those terms and exactly what buyers are looking for. And that's what I spend a lot of time doing in the pre-M&A work that I do, is all about optimizing for profitability, because for the most part, businesses, at least in the data insights and analytics sector, are largely going to receive a multiple of EBITDA. So your EBITDA is your, like a version of net profit. And so you want your profitability to be as high as possible going into an exit event or even, into a capital raise. Now, mind you, capital raise can be a little different because you're raising capital because you're not a fully mature business yet and you're looking to scale. So profitability is less important when you're raising money, but certainly when you're going to exit, you want to do everything you can to maximize that profitability. And there's lots of different ways that you can do that. And there was an engagement that I did a couple of years ago where, when I first started working with the company, they were running 10 to 15% EBITDA margins. And then, with a year or two of work, by the time they went to sell, they were running 30% EBITDA margins. Now that is a huge difference. So if you're looking at almost a 20% increase in EBITDA margins, and then you're multiplying that EBITDA by, whatever multiple it is at the moment, 10 times, for instance, that is a significant amount of money that you're now receiving that you wouldn't have received had you not done that planning and that optimization in advance.
Yeah, what a big difference. And to your point, like, not something you can do now that you're in the process.
It's really difficult. I mean, you can't do it when you're in the process, and even 6 months in advance can be problematic. I think a lot of people just wait until all of a sudden they start receiving inbound interest, or all of a sudden they're feeling burnt out and that they don't want to be running the company for an extensive period of time, or they go through a rough patch and, they're kind of just tapped out on the business. You want to go into planning and going into an exit with a lot of fire in your belly still for the business. And you want to go in as optimized as possible. If you're running your whole business off of Excel spreadsheets, I can tell you right now, you're going to get eaten alive by a private equity firm. And it's going to be really hard for you to keep up with all the diligence requests in that kind of scenario. So, everything from, raising brand awareness, making sure that your lead gen engine is rolling, making sure you have a CRM that's up to date and is being utilized, and you have all the metrics in your business. Like, all of those things are easy to implement, but they take time to really come to fruition and to really help drive that bottom line improvement that you're looking for.
Yeah, for sure. For sure. And I want to talk a little bit about the difference between capital planning and M&A planning, right? And,
Yep.
You talked about sort of like, some of the things that maybe matter more for M&A and less for capital raises and that sort of thing.
Right.
But if you're thinking, 24, 36 months out, what are some of the sort of like triggers, or how do you know which direction you want to go in or what you're planning for, right? How do you decide as a founder that you want to raise capital and grow, you know, exponentially versus grow to a certain point and exit? Like how are people making those decisions?
Yeah, I mean, usually capital planning is when you're running a growth company, and I want to clarify by saying, like, not every company is a growth company. Some people start companies with the intent of just paying themselves a salary and making some, having a nice lifestyle, and that's totally fine. They grow slowly over time. I think of those as, I don't like calling them lifestyle businesses, but I think of those as like Phoenix companies. Like, they grow over a very long period of time and there's no real intent to sell. Then there's growth businesses, and that's where we see more of this capital planning coming into place, particularly around funding. So I think that's about, understanding your sources and uses of capital, optimizing your balance sheet, sort of ensuring your financial infrastructure to support that fundraising initiative becomes really important. And for capital raises, you really have to be able to demonstrate that you have product market fit. It's, of course, there are lots of folks that raise seed rounds. You can raise a seed round, but after you're getting into, A, B, C series, like, people really want to see that there is a huge growth opportunity in the company, and that, you do have product market fit, and you do have a stickiness with customers, and that there's a real market need for what you're doing. And capital raises can be really intensive. I think the number one mistake that I see people make is that they don't raise enough capital and, early on. So what happens is, by the time they raise the capital, because it can take months to raise capital. I mean, I've seen it take 6-7 months for people to raise a round. What you don't want to do is go through that whole capital raise, and by the time you get that money, you've already spent it and you need to start raising again, because it's a huge distraction from the business. And I think, of course, people want to be conservative when they're raising, because you don't want to give away a lot of equity. Early money is expensive money. So the earlier you take money, the more of your company you're going to give up in order to get that money, versus the more you have product market fit, you can show strong revenue and maybe some profitability even, then you're going to be able to get more money for less equity. So that's something to keep in mind as well. You want to bootstrap for as long as you can until you get to the point where it's hindering growth, and then go out and raise, but raise enough so that you're just not constantly raising after that.
Yeah, that's a really great recommendation, because I've seen how distracting it can be to be in a process, to be in a fundraising process or an exit process. It takes a lot of time and energy from leadership, and that takes them out of the business. So
Sure.
to be,
Yeah, and it's the same with M&A. If you go into an M&A process, I was really fortunate in, my third transaction, that I had two business partners that were really focused on operations and running that M&A process, because I was in charge of sales and marketing. And so what you don't want to do is go into a process and then all of a sudden have your revenue numbers dip. Like, that is the worst thing that can happen, because it will dramatically impact your valuation. So I was really fortunate that I had other partners to rely on, so that I could go out and continue closing deals. And our revenue number, we would hit our revenue targets while we were doing that process, which, on average M&A process, about 8 months. So if you lose your focus because you're really focused on due diligence and the process, then all of a sudden you're not bringing the revenue that you need in order to make your projections. And then that becomes really problematic. So the more prepared you are going into that process, the more likely you are that it's going to be more of a light lift for due diligence or for, buyer requests, than if you were totally unprepared and now you're just scrambling, trying to get all of this material together. And that's why one of the things that I do when I'm doing pre-M&A optimization is I supply my clients with like a whole list, like, hey, here's all the things that they're going to ask for in due diligence and in a standard process. Here's everything that we need to be prepared for, and we need to be able to run these types of reports really quickly. And then here's all the things that they're looking for to really drive the valuation of the business, and how do we optimize the business as much as possible 12 to 24 months out, even 36 months out, such that your profitability is really maximized going into that process.
Yeah. Yeah. I'm curious too, like, I mean, it's an important balance to be able to like, yeah, keep the business growing and stay profitable and, throughout a process when you're distracted potentially.
Yeah.
But I'm also curious about the balance of like sort of planning for capital events and at the same time remaining customer centric in your business. Like, how do you balance making sort of strategic decisions for your business that work for your customers and work for, sort of meeting their needs, and also take into account the needs of investors or potential buyers for your business at the same time?
Yeah. I mean, I always kind of lead with customers first, like the customers are what actually drive your business and your ability to scale and grow. I mean, I think those two things are interlocked. I don't think that you can. I don't think you're going to have success scaling a company or even exiting a company if you don't have client fanatics that love working with you and are really going to evangelize you and are sticking with you, where you have recurring revenue and those contracts are going on year after year after year. And one of the things I always tell people, and which I also mentioned earlier, is that, recurring revenue is like gold, but a lot of services companies are like, well, I don't have recurring revenue. I'm not a software company, but there's lots of ways that you can create contractual obligations or that you can keep those relationships sticky and growing over a period of time. I think a lot of times folks are just always chasing new clients, new clients, new clients, which is important, but sometimes they do that at the detriment of your existing clients, which are really important. Like, to be able to show that you have those client relationships year over year over year is incredibly valuable to the company and will actually increase your valuation.
Yeah, yeah, absolutely. I think like being customer first is so important. Like,
Sure.
if you build a business that your customers love and want to spend money with you, that will be a business that is attractive for sale. And certainly
Yeah.
you have to, like, I want to get into some of the details on some of the optimizations that we've been talking about, but being, I have seen businesses sort of make decisions that are very sort of anti-customer and pro-investor, and that actually never pans out.
Yeah, it really doesn't. And I mean, I think one common thing that I see in when folks are preparing for sale is that their one way of optimizing the business is by cutting staff. And yeah, of course, one strategy is to do more work with less people, but that's not the only strategy. And what I see is that lots of firms go into it just with the idea of like, oh, I'm going to cut the most expensive salaries, or I'm going to cut these people where I feel like I can become more profitable the fastest. But they often do that to the detriment of client relationships. And I've seen it happen in companies. There was a company I looked at earlier this year that had done that. Somebody who, a CEO who was not that close to the day-to-day business made the decision about which heads to cut. And what happened as a result of that is that they lost a good 20% of their business because they cut like these key account managers that clients had a real affinity for. So I don't think that just downsizing your staff to increase profitability is the one and only thing that you should focus on. It's one of the tools in the optimization toolbox, but it has to be handled very, very, very carefully.
Yeah, for sure. For sure. All right, let's talk about some of these optimizations then, some of the ones that we would recommend.
Yeah.
And we've touched on maybe all of them already
Yeah.
lightly. But I want to get specific first on the kind of revenue optimization side of things. Like, when you're preparing for any of these events, what needs to happen with your revenue optimization and improving profit margins, and why does this matter? What are like investors scrutinizing on the financial side of things?
Yeah. So although your company is going to be valued on your trailing 12 months of performance, what buyers and investors are buying are your future cash flows. So they're scrutinizing revenue quality, not just revenue quantity. They want to know that you're going to be able to make your projections and the business is capable of growth into the future. And so there's a few key metrics that generally buyers really care about. That would be revenue growth rate. So understanding what that is, ARR and MRR, if applicable. So that's, annual recurring revenue or monthly recurring revenue, your gross margin, your EBITDA margin, your net revenue retention, and then of course, customer churn. So those are all the key metrics that buyers are really looking at. What revenue optimization means is that, we're working on cleaning up pricing. We're eliminating unprofitable clients or product lines. We're shifting toward contracted or recurring revenue where possible. We're trying to do more work with less people. We're using marketing and less expensive lead gen techniques to drive growth versus this sort of one-to-one sales outreach. So those are all sort of important things to think about when you're thinking about optimizing your revenue or your profitability. On margins, so on your profit margins, buyers are actually going to normalize your financials. So they're going to strip out owner perks, one-time expenses, add backs. You want to make sure your story about the business holds up after that normalization. So, lots of times what I'll do is I'll spend a lot of time going through the financials and figuring out, well, what are add backs? Like, what are the things that were kind of exceptional, an expense that occurred in the business that isn't going to be reoccurring. But you want to make sure that you're actually capable of running the business and meeting your growth targets after that normalization. So that's super important. As I mentioned earlier, your EBITDA multiple is the most common valuation lever in the data insights and analytics space. So every point of margin improvement can translate to significant multiple expansion at exit, which is ideal, of course. And I think the question that founders really need to ask themselves is, can I explain every revenue dip, every spike and trend in the last 3 years? And if you can't, then now is the time to do that work.
Yeah, that's I think that it's interesting that sort of like looking back at the revenue last 12, 24, 36 months of revenue in order to predict future revenue and sort of rely on that is interesting, especially with maybe higher growth companies or
Sure.
ones that are very early stage but kind of taking off quickly. There's that might feel very exciting in some ways, but maybe unreliable if there's not a lot of historical data to back up what the future is saying. So I've heard you say this a couple of times, this like, make sure your story is matching the data. And that's hard, especially when I think there's a lot of people who are, very passionate and excited about what they're building and really optimistic. And that's great. But it's so critical to have the right data points in place to back that up.
For sure. And I think that, again, comes back to process documentation and using systems so that you have easy access to that data. Again, like I was doing a pre-M&A optimization for a company that was about 35 million in revenue a couple of years ago. And they were running the whole business off of Excel spreadsheets. So they didn't have a CRM system. and they were really resistant to putting one in. And I was trying to understand the resistance. And they're like, oh, well, we got to 30 million without having a CRM. So we don't really understand why we need one now. And I said, well, you got to 30 million in spite of not having a CRM, not because of that. You got there in spite of. Imagine how much larger the business could be if you could more accurately track, like, what are your conversion rates? What's time to conversion? How are you bringing new clients in? Where are clients and why are they churning? These are all metrics that as you get bigger and bigger, you're losing touch with that one-to-one client knowledge as the business expands. When you're small, when you're $1 million of revenue, of course, everything that's happened with every account, but as you get larger, you don't necessarily have that information. And so it becomes much more difficult to tune the business.
Yeah, that's, perfect segue into the next topic that I wanted to dig into, which is exactly that. Those like operational systems. We've talked a little bit about CRM and the benefits and sort of why you need that. Like, when buyers and investors are sort of like starting to look under the hood, what do they need to see from operational efficiency, operational readiness, like business process and documentation? Like, why is all of that so critical? Like, what are they looking for, first of all? And what do you need to have in place to make sure that the process is going to go smoothly?
Yeah, I think the one core question I hear from a lot of buyers are, can this business run without the founder? If the answer is no, they'll either discount the valuation or they'll just walk. They won't do the deal. So when I think about operational readiness, I think that means, documented standard operating procedures, having a clear org chart with real accountability, having a technology stack that scales if you're, a tech-centric business. And I think delivery processes that aren't in somebody's head, and particularly someone's head that could just walk out the door tomorrow and you would be sort of lost without them in the business. So when I look at sort of specific red flags and diligence, there's an issue when everything goes through one person, where there's no CRM or project management system, and where client relationships are purely founder driven. Like that is problematic. And a lot of folks are, I hear a lot of folks being resistant to documentation, saying, oh, I don't have time to document everything. But documentation matters. It's not just about diligence. It's about the fact that documented processes are a signal of a mature and scalable business. It de-risks the acquisition for the buyer, and it also protects your employees post-close. So I would say as a practical starting point, map your top 10 business critical processes and ask, if I were hit by a bus tomorrow, could my team execute this? Like, that's just super important.
Totally. And that's not even that's just like a operating your business kind of recommendation, right? Like, as somebody who is constantly trying to build more documentation into our processes, like, it's not easy. And I totally relate to that. Like, I don't have time to document this stuff, but as you grow, and not even grow big, but grow a little bit, and you start hiring people, being able to ensure that what your team executes is repeatable and consistent, regardless of who's doing it, is so important. And it's not like it's not that easy to do without it actually creates a lot of sort of inefficiencies in how you run your business day to day, when everybody's constantly having to ask each other questions about how to do their job, right? And that's like, investing that time up front is going to help your business like operate more efficiently, probably help you grow and scale faster and retain your clients better. And then, by the way, now we've gotten to a capital event and you have all of this stuff documented. And like you said, that de-risking it for the investors or for the buyers is so, so important. But I mean, some of these things are like, yes, we're talking about planning for a capital event, but this is just like recommendations for how to grow and scale your business efficiently and effectively.
Yeah. I think a lot of times, from my experience, I see founders who want to hold all that information because it's a control issue. And they think that if they're controlling every step of those processes and that they're the single point of information, that is going to ensure the success of the business. I find the opposite to be true. I think that the goal is to hire people who are smarter than you at their jobs, that understand how to get things done, and where you're not becoming the bottleneck for the business, because you will never scale if you are managing everything. I mean, I did an engagement for a company a couple of years ago where the founder was still booking all of the company travel because they wanted to have control over the, how people traveled and where they stayed, versus just coming up with guidelines that you would put into an employee handbook and say, this is how much you can spend. This is the type of hotel that you can spend. Here's how much you can spend on a flight without permission. Like, it seems so simple, but it's really hard for a lot of founders to give up control. And I always tell people, like, you have to let go to grow. You can't do everything yourself. Not everything can run through you, or the business inherently will not scale. So, and it's hard for folks, myself included, because I have a certain way that I like things done and I want everything to be done my way. But the truth of the matter is that, I got a really good piece of advice, after I sold, I think when I was in my second company, and it was like, don't let perfect get in the way of good enough. Like, it doesn't have to be exactly how I would do it. It just needs to get done.
Yeah. Yeah, for sure. And I think there's sort of a hierarchy of, here's the thing that has to be done a certain way, and here are the 10 other things that just need to get done, like you said.
Yeah,
right?
exactly.
Doesn't mean you have to sacrifice everything. This is my parenting philosophy, right? Like, I got to pick my battles sometimes. I can't fight about everything. Otherwise I'd be fighting all the time. And I think it's business. Yeah. It's like there's hills that you can die on, and then others that you just have to let go.
Exactly. Yeah.
So let's talk a little bit about anything like sort of beyond revenue and operations.
Mhm.
Like what else is critical for a business to be ready for an M&A or capital event? And what happens when the buyers and investors really start digging in?
Yeah, I mean, diligence goes deep. I've likened it to like a full body cavity exam for like 45 days at least. Diligence goes really deep. Buyers and investors are going to look at legal, for instance. So any contracts you have, IP, any litigation that you're either actively involved in or were involved in the past. So that's all part of legal. They look at HR. So those would be employment agreements, contractor classifications, key person risk, insurance, how the business is, covered and from an insurance and liability perspective. They're going to look at your technology. If and this is not like if you have a CRM or like processes, but if you have proprietary technology, they're going to look at IP ownership, security, the stability of the product, the scalability of it. And then they're going to obviously take a deep dive into your customers. So really understanding how your sales and marketing engine works, how you're driving lead gen, what those conversion metrics are, what your customer concentration is, what your customer satisfaction is, any of your contract terms. Those are all things that buyers are going to be looking at. And I think one often overlooked area is data governance and compliance, particularly these days. And I think it's really relevant in the data and insight space where privacy regulations like GDPR and CCPA can provide real exposure for businesses if they're not handled correctly. So having an understanding, having a data governance and compliance policy becomes really important, and most folks don't have that.
Mm.
I would also say your customer contracts just matter enormously. Like, do they have assignment clauses, change of control provisions? Most founders don't know that, or that's not in their contract. And then I also think culture and leadership bench depth get evaluated too. Buyers want to know who stays, who's at risk of leaving, and what retention looks like post close. And what I always do in my pre-M&A optimization work is I build a shadow data room before you need it. So it's like just can be like a shared file or a folder on your shared drive where you have all of your key documents organized and current, so that when you go into a process, like you're not caught flat-footed, that you really have all of this documentation already, and it's just a matter of then uploading it into the M&A data room. You've got all those documents in place and you're ready to roll.
It is so frustrating to start to work on a data room and not know where everything is.
Oh, it's terrible. And when I sold my first company, that was really before you had electronic data rooms. So I had to print everything and put it in binders. I mean, I'm sure I still have a data room binder somewhere, but I mean, it was.
It's an art.
Printing out every customer contract, 3-hole punching it, putting in a binder at like 1 a.m. It was misery.
Yeah. Well, thankfully it's a little easier now, but these are like great recommendations for how to make it easier on yourself for when you get there, and not just for that to happen, because it's so time consuming to put them in the right folders or.
Right. And that's the issue. Like people get so busy running the day-to-day business that they kind of forget how important it is to know where all that information is. And you might have all that information, but it's scattered around even virtually on different drives or with different people. Not all folks, even though there are shared drives, I think everybody knows not everybody saves everything they have into the shared drive. Yep. Or there's not CRM compliance. And I used to joke about this when I was, a partner in running sales and marketing at Decipher. We would have these weekly sales meetings, and I, who was running sales and marketing, was literally the worst at compliance for CRM. So, I mean, if I can't even get it together, how do I expect my team to do it? So, right. All of those activities become really important in terms of documenting behavior and going into that process really, really prepared.
Yeah, for sure. For sure. So if somebody's listening today and they're wondering whether like they need to be thinking about doing this, or like how they even know how ready they are, how can they kind of assess that for themselves? Are there like warning signs or questions they should be asking themselves about whether they're ready or need to start planning now?
Yeah. I think it's never too early to start planning for an exit event. And likewise for, capital raise. I think if you're going to do it down the line, like you want to go in, you want to start your business off very structured and with that sort of documentation ethos in mind. But I would say going into an M&A event, there's kind of 5 questions that I recommend that people ask themselves. The first is, can someone other than me run this business for 6 months without major issues? The second is, do I have 3 years of clean, audited, or reviewed financials? That's very important. Third would be, is more than 20% of my revenue from a single customer? If it is, you have a customer concentration problem. Number 4 would be, could I tell the story of my business, its growth, its competitive position, its future in a 20-minute pitch? Can you do that? And the 5th and most important, I think, and this is something not a lot of people will talk about, is, do I know what I want to do after the transaction? Do you want to go on with the company? Are you trying to exit? Because that will drive a lot of who the ideal buyer is. A lot of folks who want to exit after the transaction or exit in a relatively short period of time after transaction are going to prefer to go with a strategic buyer, which would be like another company or competitor to your business, because that gives them the opportunity to exit, versus some folks who go through an event because they have a lot of fire in their belly for the company and they want to go through a recapitalization of sorts, that the business gets additional funding, they're able to take some money off the table, and then they can really focus on growing the business. So having an understanding of what your ideal outcome is from a transaction is super important. And then there's some warning signs that you're not ready. So warning sign would be, you can't answer basic financial questions without calling your bookkeeper. Your team doesn't know the company's strategic direction. It could also be that your contracts are handshake deals. So yeah, somebody's promised you a certain amount of revenue, but it's not actually contractually obligated. And I think that this kind of readiness test isn't just about the business. It's also about you, the founder. Founders who haven't processed what an exit means emotionally are the ones who blow up deals on the finish line. And I've seen it happen multiple times. Going through a transaction is a very emotional process for founders generally. Like, I can remember when we sold Decipher, I remember the deal closed. I think it closed on Thanksgiving or the day before. And then a couple of days later, my business partner, Jamin, called me at 7 a.m. and said, the deal's officially done. Check your bank account. And I did. And there was a lot of money in it. And then I literally just cried for like an hour because it was like a dream come true to sell that business, but also, like, what does that mean? Like, I've just given 7 years of my life to this business and now somebody else owns it. And like, it was just a very emotional process for me, because it was kind of like selling your baby. So, I would say, like, be prepared for that. And then also, the best time to start this prep work for the business is 3 years before you need it. And then I would say the second best time, as I've heard many people say, the second best time is today. Start today.
Yeah.
There's a lot of, particularly if you're an early stage company, get these processes and systems in place now. It's going to save you a ton of headache down the line. It is so hard to to like get a CRM installed when you're a $30 million business than when you're, sub 1. Mm-hmm. So start now, would be my recommendation.
Yeah. And I think a lot of the recommendations that I've heard from you today, like, it's not anything that is too sophisticated for a small business or too hard to do, or, I just was talking to somebody recently about, just asking for recommendations about CRM for a small kind of solopreneur kind of business. And I'm like, HubSpot and some others as well, like, it's free. It's actually a free tool to use. Use it as much as you can, the free version. And then when you hit like a feature block, then buy the starter pack, which costs you $15 a month or whatever it is, right? And, you can slowly grow it from there. But just starting out with that right mindset and the attempt to do it, if you do it right from day one, it's not a hard transition.
For sure. Yeah. And I think what I try to do, I think for a lot of founders, it's like they don't know what they don't know. And so they don't really know where to start. And so I think that's the benefit of this growth optimization work, whether you're planning for an exit or you're just wanting to scale, is having somebody that's been through it that can say, okay, here's the 10 things that we need to do, and here's the order we need to do it in, and here's like the timeline for doing it, and here's how we're going to implement and bring all those things together. I think that's very hard for people to wrap their heads around when they're actively running the business day to day. And I also think it's the difference, and I've said this to many clients over the years, when you get to a certain point, you don't want to be working in the business day to day. You want to be working on the business. Like, founders shouldn't be in the business so thick that they can't focus on these larger, more strategic imperatives. That becomes really problematic, and the business won't scale.
Yeah. And it sounds so simple when you say it like that, but
no,
it's hard.
Not.
Yeah.
That's why people hire me, to help them with it.
Exactly. And so I just, thank you so much. I can't thank you enough for coming on the show today and talking about this. And, please do follow Kristin and talk to her about this stuff. We are hosting a webinar at the end of the month, March 19th. So you guys can register for that. And we're going to talk even more about this stuff. And Kristin also leads our Build for Scale work at Growgetter, helping businesses prepare for M&A, capital raises, and major growth events. So if you want to learn more about that, reach out to us, or you can come to the webinar. But thank you so much for joining today. This was such a great conversation.
I love talking about growth. So anytime.
Awesome. Thanks everybody for listening in. If you enjoyed today's episode, please subscribe to Marketing Demystified wherever you get your podcasts, and join us next time for more conversations that help demystify the complex world of marketing and growth.